Yeah, let's hear what they told you about before the last trade.
No, that's the whole thing.
But they do. That's the whole thing. When I presented to the New York Fed, and that's hard to believe, by the way, that they'd actually invite me. John would probably laugh at that.
Well,
but they have it's basically all market intelligence. They have a lot of young guys that are sitting there, and they're trying to figure out what's happening in credit markets, what's happening in terms of liquidity. There's a whole host of things that have nothing to do with employment that the Federal Reserve is going to have to acknowledge. This is, again, as Dagan pointed out, the worst stock market start to the year ever. And again, I don't need to.
Ever needs more syllables.
Ever is a very
so bad.
Ever is a very long time, is what I would say, and that's the most important point. They have to acknowledge that.
It's explicit in the minutes. They talk markets. They talk how strong the dollar is. This is not economics. This is not full employment and growth. That's not
folks,
not the game anymore.
Let's keep this in context. They talk about markets because they want to get a sense of what the markets are telling them about where the economy is going to go in the long run. You know, they're concerned about the stock market because the stock market might be saying, hey, this economy is in much worse shape than you guys thought it was. So that's why they want to hear what you're thinking.
Lindsey, I want to bring up this point. And John and I have talked about it in the past. If these markets and all the talk about how awful the markets are, if it starts to rattle individuals, they can change their behavior. And just that very thing can lead to a recession. It might not be one now, but if people really start pulling back for fear that their own personal situation is going to get worse, that could cause a recession.
It certainly could, but remember, the Fed is basing their subsequent rate hikes at this point on their own internal forecast, and their internal forecast says that we're actually going to see more improvement in the U.S. economy. So even if we do see a disappointing employment report, and even if we don't see improvement in inflation, the Fed is very clearly focused on their expectations and not the lack of realized improvement. So I think it's going to be very difficult to argue that we see no additional rate hikes or even one additional rate hike. As we heard from Stanley Fischer say, more in the ballpark of 4 based on what they anticipate. Now, the Fed is often wrong, but they're going to base those subsequent rate hikes on their internal forecast at this point.
But Lindsey, they also say it's data dependent. So I mean, they're going to go based on how their forecast. I think it's very clear that they abandoned their data dependent stance, or they never would have seen liftoff in December. They were very clear that they don't need to see improvement. We got an unemployment rate continuing to come down, and I think they're going to move based on how their forecast evolves. So, if we get bad data and they've got to start marking down numbers the way Wall Street marks down numbers so often, then it is going to be tougher for them to move.
And the way the Fed, don't forget, John, has marked down numbers. The Atlanta Federal Reserve has taken their GDP estimate to 0.7%. They raised rates and cut numbers. It was amazing.
Jack, I want to get Jack in here. Go ahead.
Sure. So a couple of things. First of all, the market thinks that there'll be 2 rate hikes next year. And to me, I mean, Mike's a brilliant guy. This year, excuse me. Yeah,
Happy New Year, Jack.
Oh, my gosh. Did the ball drop already? I love Mike, and I like John Hilsenrath, but I think camp is less important than what the market predicts. Those are millions of people putting money on the line. The futures market says 2. I'm going to go with 2. But importantly, bringing in China, bringing in the markets, the fear is that China is exporting deflation. Yeah. Deflation is the Fed's single biggest fear. So that's why they're watching what's happening in China so carefully, because we're talking about wage growth. If we don't have wage growth, that's a fear, not just because we're not getting more money, but because then we'll be buying less stuff. And you get a very dangerous spiral, and the Fed can't get us out of that.
Yeah, and I think that's the key. I mean, we've started to see consumer spending start to tick up. We saw some decent retail sales numbers. They're still coming out. But the wage piece, I think, is what's really crucial here. And I don't think we're going to see too big of a surprise with the employment report today, because we're also looking at unemployment claims have been at, really kind of record lows. They've been coming in lower than expectations. We're seeing the 4-week average down below, 270,000 for the week. Anytime that number is below 300,000, that's signs of we're still in a recovery, we're still growing, and the employment picture is really improving.
John, I'm going to give you and Lindsey the final word.
I think a 200,000 number today takes some of the worry out of the markets that all of these international events are spilling over into the U.S. economy.
Lindsey?
I think it's very clear that the bar of expectations for the U.S. economy has been lowered so precipitously that 200,000 is now the bar for strength in the U.S. labor market.
Lindsey, thank you so much for being here. Lindsey, Piegza, and John Hilsenrath. John, get your butt to New York next week, please, sir. We'll see you then.
See you on Tuesday.
Okie doke.